What we're trying to do here is forecast the value of the equity. In order to do that, we are going to be looking at what is the total value of the assets, and then subtract from that the value of liabilities to get to the value of the equity. The reason we're looking at the value of the assets is because it's a much more stable value. Equity and liabilities, the cash flow and the returns, vary depending on the level of borrowing that a company has. And I'm going to attempt to show you that in this spreadsheet. So this is the example we had in the initial video. The video that's explained about cash flow from assets and liabilities and equity. So we had $2,000 worth of assets that required a 10% return because it was that risky. So that means it generates $200 or 2,000 times 10. We also had liabilities, which ownership from the bank or bondholders of $500 that required a 5% return. And that generates a $25 a year interest payment. The equity then by difference is the 2,000. I'm just going to do it this way: 2,000 minus the 500, which is 1,500. And the cash flow also by difference was 200 minus 25, or 175. And the return on the equity is actually this 1,500 divided by the 175. The 175 divided by 1,500, which shows that we require 11.7%. Now, what I'm going to do is I'm going to just assume that it's pretty likely that the value of the assets aren't changing over the time. We're not reinvesting, we're not divesting, they're just continuing to chug away. But what is happening is we're going to start borrowing some money. So I'm going to say each year we're going to increase our borrowing. The first year to $750, etc. And the required return is going to be about the same because we're still not really over a huge amount. So that means the interest payments then are going to be increasing over time. $750 times 5%, they're going to be increasing. And then by difference, we have this the amount of equity that's in for the equity holders. And then again, by difference, we have the cash flow that goes to the equity holders. And if we then calculate the return on equity required, or the return on equity that's actually received, you can see that it's increasing. So in this last case, because we've switched from a quarter debt to 3/4 debt, the required return on equity has gone up. So all I'm trying to show you here is that this equity value depends a lot. The return on equity and the cash flow from equity depends a lot on the level of liabilities, but the asset values are constant.